Welcome back to Real Estate Mindset. Happy Friday morning. Thank goodness, or thank gosh, it's Friday. Congratulations, you guys. We made it. And also, it took me a few hours, but I set up a temporary new studio. Okay, so it's only temporary. I got some really special things planned. I hope you guys like my new studio. All that you guys can see now is just trash. It's just the hustle sign. You got the bear in the background, just like me. I'm a bear. You got the plaque right there. I love you guys. Thank you so much for that. But this is just a temporary studio. I wanted to do, put a lot of heart, a lot of soul. I wanted to be here again for you guys today, even though it was hard, to show you that, hey, I can work hard too. I'm just like you guys. So let's keep working hard. Wanted to say good morning. And I hope you guys really, really enjoy the show. Good morning, everyone. And I was talking to you guys. Good morning. I was talking to some of you this morning. We were chatting back and forth. So I really, really appreciate you guys showing up early. We do have some movement in the markets, you guys. I'm going to start right away on the mortgage update. And we're going to take a look at the 10-year right now. Let me see. How do I want to do this today? Let's do it like this, okay? So here's the 10-year right now. Now, the 10-year sitting at 4.27%. It has gone down from about 4.5%, but we are still elevated. I wouldn't worry too much about it going down over the last, 2-3 weeks. But it has, here's the interesting thing, guys. It was trending upward. Okay. It's trending upward. And you guys see that it just literally right before I started the live, it actually plunged. Do you see that? So the 10-year did drop. We watched the 10-year treasury because it tracks residential mortgage rates. We don't watch the federal funds rate because it's not the federal funds rate. We watch the 10-year, the longer end of the yield. But anyways, guys, it did plummet. Isn't that crazy how fast news travels? So as soon as news hits, money just fluctuates all over the place. Very, very rapid decrease there. Now, here's the reason why the 10-year plummeted, about 5-10 minutes ago? Right here, you guys, the PCE report came out. So PECE, inflation came out today, and the report shows no price increase. If you guys can, let me know that my internet connection is still good. I'm getting like a signal saying that my internet maybe not good. Can you guys just comment below? Let me know that it's okay. But regardless, you guys, that 10-year did drop because the inflation report came out basically unchanged. So when inflation reports come in basically flat or low, that 10-year is going to sink. When inflation comes in hot, that 10-year is going to explode. And can you guys just let me know that my internet's okay? It looks like it's going okay. Good. You guys saying that's okay? All right, I'll shut up. I'm sorry. All right, guys. So that's why it's going down. But take a look at where mortgage rates ended on Thursday. So we're still, again, you see what I mean? We're still at 7.05%. It's looking like that 7% is the magic number to curve the housing market. This is a great thing. We may look and see and find headlines that says all-time record high price. So brand new record, like, oh my God, the housing market's going crazy, but it's not. It's not going crazy despite the headlines. You guys, these 7% mortgage rates is killing the housing market, and it's keeping the demand to sell locked in the houses. When those rates go down, you guys, there's, depending on the type of rate cuts, if it's only a quarter rate cut, I don't think it's going to have much effect. But if it's a massive rate cut because of recession, because of unemployment, there will be a flood of inventory. And think about this, guys. Okay, so think about this. So when we go into recession, we may have three things happen. So we go into recession, what happens? Unemployment. Okay, now what's going to happen next? All right, prices of houses should go down at the same time that interest rates go down, at the same time that inventory explodes. It's a triple whammy. Just saying, guys, that's I am like convinced that's exactly what's going to go down. But here's the mortgage rates as of yesterday. So conventional sitting at 7.05%, 30-year FHA sitting at 6.49, the lowest of the bunch. Today is the 15-year fixed mortgage, which is 4 basis points lower. You can see VA is sitting at 6.5%. But again, conventional mortgages, most people are taking this right here. 7% is really whacked the market really, really good, guys. Now, take a look at the optimism in the market, or rather the foolish optimism in the market. I see you guys. Good morning. It's so nice to see you. Winnie the Pooh. Oh my gosh, it's so nice to see you. Always nice to see you as well. All right, guys. So let's keep going here. There will be, okay, so here we go. So what signs do you see that there will be massive unemployment? What would cause it to happen? Can you guys answer that for him? I want to see how good you guys are. What would cause, why would I think unemployment's going to happen? Okay, I'm going to give you a clue. All right, it starts with Q and ends with T. Okay, that's your clue. All right. I want you guys to answer that question. If you've been watching, you should be able to answer that for him. But anyways, guys, here's CME Fed Watch. Here's what the market is anticipating. It's fluctuated a little bit. I don't know why we even go over this. I mean, the market's always wrong, but it's shifted to one rate cut, 6.1% no rate cut, but 30.4% chance now one rate cut with a 43.5% chance two rate cuts. So the market is adjusting to 1 to 2 rate cuts. It's still leaning towards 2 rate cuts right here. And when I say 2 rate cuts, guys, I'm talking about 50 basis points. So it could be a quarter and a quarter, or it could be 10, 10, 10, 10, 10, or it could be one cut of 50 basis points. But regardless, it's saying 50 basis point rate cut. Now, let me show you how much mortgage interest you guys are going to pay if you decided to purchase right now. Now, I'm going to tell you guys, all right, overall, listen to me. People keep getting this wrong. Overall, okay, unless you're House Hawker, Jeff, Raymond, I mean, a couple people are doing this, but overall, it is an absolutely horrible, toxic time to buy. And we're starting to see multiple stages of the economy and housing market start to fall apart once again, like we saw in 2022. So if you wait right now, I think it's best, guys. I really do. I think you're way better off waiting, because again, if we go in recession, unemployment, what do you get? You get more inventory, lower interest rates, and lower home prices. And that's why. All right. But again, if you're going to buy right now, so be it. Let me show you what you'll be paying with interest. Now, I changed this, guys. I wanted to show you a $500,000 loan now. So a $500,000 loan at today's interest rate, or yesterday's 7.05%. Oh my God. Look at how much interest you pay over the life. $703,000. The total amount you pay back on $500,000, y'all, is $1.2 million. Literally, it's a mortgage is a death contract. Now, if you want to become a winner, if you want to break that shackles of debt, prison, and be free, all y'all have to do is just pay a little bit more towards principal. Let me show you the first year how effective paying down your principal is. Now, you guys see the first year of this loan at 7.05%. You guys pay back $35,000 in just interest. So year one, you pay back $35,000 in just interest. Meanwhile, you only pay your loan down about $5,000. So if you guys want to be proactive, if the same day you close, say the same month that you close, if you pay down $5,000 of your mortgage, how much do you guys save? Anyone in the comment section? There's Adam. Tell them how much. You're the realtor, Adam. Okay. We expect you to know more than us, Adam. Okay. Tell me what the answer is on that. But regardless, you guys pay $5,000, you save $35,000 in interest. Y'all see my point? Like, just pay a little bit of principal. That's it. Now, if we want to make optional extra payments, let's just say extra monthly payment of what? What do you guys think? Just a little bit. Let's just say $80. Okay. I'm only using $80 because pretty much everyone should be. So it's not going to save a lot, but let's just see what a little bit does. Okay. So $80, let me calculate. Okay. So if you pay $80, you save 2 years and 2 months. Okay. And you save, let's see here, $62,000. You guys pay $80 extra a month. You save 62 grand. Okay. But again, you guys, that's off a $500,000 loan. I mean, you guys, holy smokes. Now, I wanted to talk about a couple things, and then we're going to go into our first video, basically about like, how do you get the lowest interest rate? Like, what's the best way to get the lowest interest rate? Now, remember, I've been saying this, if you've been watching me, if you've taken my home buyers course and you have great credit, you guys should be getting rates about 0.5 point lower than what you see on Mortgage News Daily, about 0.5 point lower. Now, obviously, guys, generally, unless it's FHA, generally the way you get a good interest rate, number one primary thing, credit. Right? You got to have good credit. And remember, guys, the credit goes in tiers of 20. So you go 600 credit score, 620 credit score, 640, 660, 680, 700. So every tier is a pricing adjustment. Remember, we've been talking about pricing with interest rates. You guys, that's called LLPA. So now you guys are experts on something called, not experts, but you're starting to get LLPA, which is loan level pricing adjustment. All right. So another thing, your credit, but also your down payment. Again, that's primarily with conventional. With FHA, your down payment really doesn't matter if you go more than 3.5% down. Another way to get a better interest rate, and this is not as effective as far as credit and down payment, is your debt to income ratio. Now, what I mean is sometimes if your debt to income ratio is too high, you get an LLPA. Remember, pricing. Okay, so your pricing, because it's not about interest rate, it's about pricing. Your pricing gets worse. Okay, remember it's pricing, guys. You get a hit every risk there is. So pricing is like risk for the lender, and they pass the risk on to you, even though it's not really a risk for them because they always make money. Now, the last thing, guys, the fourth thing is the type of loan. So remember, the type of loan also, that's going to fluctuate your interest rate. Almost every scenario, not every, but almost every scenario, FHA will have a lower rate than conventional. Literally, guys, almost every single time. Now, also PMI, okay, private mortgage insurance or mortgage insurance is really the only reason why conventional mortgages are more beneficial in some situations, not in every situation, but PMI, guys, or mortgage insurance essentially is a waste of money. With conventional, if you put 20% down, you don't have to pay mortgage insurance anymore. If you put less than 20% down conventional, the mortgage insurance will automatically go away once you have 22% of equity. However, by law, you can write in or call into the lender and request PMI be removed from a conventional mortgage after 20% of equity. Now, FHA, you can't do that. FHA, it lasts forever. So, in other words, at least conventional, there's hope of mortgage insurance going away. But that's my point, you guys. It's not always beneficial because most people refinance. And I want you guys to remember how expensive refinancing actually is because you start that amortization schedule all the way over again. So let's move on to our next video. I'm sorry, our first video. And our first video is going to be on consumer confidence. Consumers are getting beat up. I don't trust a lot of this data, you guys, because I see what's going on. I know people, I feel it myself, but consumers are getting wrecked. I'm going to show you some data in a minute, but let's start our first video again with consumer sentiment. Okay? Hope you guys enjoy.
Yes, consumer confidence for the month of June. In addition, we have some Richmond Fed indices. On Richmond Fed, if we look at the manufacturing side of the equation, expecting a number -3, comes out -10. That's the weakest, biggest negative month-over-month change since March. And if we look at the service side, the business conditions at -11, that's the weakest since October of last year. On June, consumer confidence from the conference board, we're expecting a nice even 100 on the headline. Comes in a little better than expected, 100.4, and that follows sequentially 101.3, which is a downward revision of what was originally reported as 102. If we look at the present situation, 141.5 comps to last month, which had a huge downward revision, all the way from 143.1 to 140.8. So big downward revision there. So 141.5 now stands as the best level going back to March of just this year. And finally, if we look at what may lie ahead on expectations, 73.0 sequentially following a slightly upward revised 74.9. 73.0 is the lightest level since, well, very recently, since April of this year. Most of these indices don't seem to have moved the market much, but that big revision to the present situation is something to pay attention to, with anecdotal evidence that they're slowing within the economy. If we look at interest rates this morning, we're hovering around 473 to 474 in a 2-year, which is a very sideways consolidation level. And as for 10-year, keeping a close eye on 4.25 also seems to be recent home base for 10-year note yields.
All right. So obviously consumer sentiment is not doing so well right now. Thank God. I mean, it's shocking that it's been so high so long, and you guys want to know, and I want you to really start thinking about this. Now, I know you're probably watching just to learn about the housing market, and me too, I just want to buy a house and move on with my life, right? And go sell real estate again once I believe in it. I just don't really believe in it because I just don't trust consumers to make the right decision. And I mean, it is what it is. This is just, it's so crazy when you think about the economy and you think about the consumer spending, okay? It's based on confidence and trust. The whole economy in the market is based on emotion. Isn't that amazing to you guys? Confidence and trust is what keeps things going. Really, really crazy. Wanted to throw this comment up here real quick, not to pat myself on the back, but just to remind you guys, tell you kind of what I'm going through. This is from, I can't pronounce that, but blah, 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 okay? Travis, proud of you. I lived in, and I want you guys to think about this, but I lived in a mold apartment a few years ago, landlord half assessed the repair. Exactly. Nothing feels worse than having your family in a hotel and feeling like you can't return home. And I appreciate you saying that, brother. It has been really hard. It has been really hard. I mean, I feel like for the last 7 days, you guys, because my wife has had bronchitis as well, and she's been sick, and so have our children. And we found out our home that we're renting in was full of mold. And yeah, I mean, everyone's getting sick. I felt a little bit worthless. I felt irresponsible. I felt like I was putting my family in danger. I know this was just in my head, but I stopped everything I was doing. I tried to buy a house, you guys, but you guys know I am not going to settle no matter what. I'm not going to settle. But I did try to buy. I used all my fundamentals. I found plenty of homes with wedge. Couldn't find cash flow. But it's scary, man. I mean, every type of life event. I want you guys to think about life events. If not everyone, but a lot of people, if they're purchasing a home right now, they're going broke purchasing a home. I've been a loan officer for 22 years. Most people go broke purchasing a house. Not everyone, most people. And if a life event happens when someone purchases a house, they could be financially ruined, you guys. Thank God that I have enough money right now and I didn't just go broke buying a house, that I have cushion where I can pay my moving expenses, utilities, deposits, new security deposit, pet fees. It's just very expensive, but we did make it. We are moved in. Again, you guys see a temporary studio right here. I'm so excited to show you my studio. I love doing cinematography so much, you guys. I want to be now, but one reason I'm saying this is you got to have that cushion. You got to have that cushion. And then also, that's the only reason why I haven't been outside. I've been outside. My plan was do the Hammerhead documentary. If you guys haven't seen that, Spartan Tackle Fishing, and then come back and do a whole bunch of outside videos. But boom, as soon as I got back, everyone was sick and we had to get out of there. It was very, very scary. And, I worried about my people, worried about my family. We got to worry about them, but I acted very quickly. We're going to move on to the real estate section now. Now, this real estate portion of this video, I'm going to talk to you guys about something that I'm kind of calling now a double bubble. By the way, it just hit me. Do you guys remember that video game Double Bubble by, was it Nintendo? I could never beat the final I almost beat the final stage of the Bubble Bubble. Was it Double Bubble? Yeah, Double Bubble. So anyways, we're in a double bubble like the 1990s, 1980s, 1990s. Anyways, do you guys remember Double Bubble? I'm serious. So we're going to talk about the Double Bubble. Let me throw this on the screen. Now, first, this is what I wanted to show you. I wanted to show you, first of all, the when the Federal Reserve started trying to do quantitative tightening. Okay, so take a look here. So here's the GFC. This is 2007. All right, and what you're seeing is Case-Shiller over CPI. The reason I'm doing that is to show you the size of the bubble. Okay, so here's the GFC. Okay, got really ungrounded from that black line. You guys can kind of see the black line. It doesn't really show up too well. You can kind of see that black line right there. See that? All right, so you can see it went down here, but then it started going up again and started basically detaching from fundamentals. Okay, so right here in 2016, that's when the Federal Reserve started doing quantitative tightening again. They started selling mortgage-backed securities and they started lifting the federal funds rate because they wanted to tamper down probably spending and probably the housing market. Okay, so again, I'm going to show you that, but instead, all right, look at what happened. Instead of that bubble getting smaller, again, and I'm going to show you the data, it freaking blew up. We're in a double bubble. We have this bubble here, okay? And then we have the second bubble right here. And I'm going to show you guys, look it. I don't have to guess, okay? Look at this. This is mortgage-backed securities. This is quantitative tightening and quantitative easing. What you're looking at is, again, QE and QT. This is it. This is quantitative tightening, quantitative easing. Look at it, okay? This is what I'm trying to show you guys. In the beginning of 2018, look at it. They were doing quantitative tightening to try to conquer that bubble. We're in a double bubble. Look at, they're selling mortgage-backed securities. See, this is the Fed selling mortgage-backed securities. This puts more pressure on the markets, hopefully, credit tightening. But instead of that, they were doing that for about, what would you guys say, about a year and a half, 2 years. Instead of that, look at, freaking blew up, destroyed us, man. This should be criminal, by the way. It blew up. So again, I'm trying to point out the double bubble. They were selling mortgage-backed securities and doing a form of quantitative tightening right before all hell broke loose. And look at, guys, that's with the federal funds rate as well. The federal funds rate was 0% up until 2015. The federal, again, okay, especially for millennials, Jeff probably already knows actually, but the federal funds rate was 0% for like what, 5-6 years. And look at, in 2016, okay, beginning of 2016, they started raising the federal funds rate. See that, guys? Again, what I'm trying to say is they were trying to combat the original bubble. We are in a double bubble, but instead of them staying high, okay, look it went back to zero. And now we're in a double bubble. Y'all know what I'm saying? Y'all see the double bubble? No. Okay, fine. Let's not talk about the bubble. Let's not talk about the PE ratio or the payment to income ratio or just how unaffordable the housing market really is. And let's not talk about how kids have never experienced or don't even know what an overpriced house is. Let's not talk about all that, okay? Let me talk again about leading indicators that I believe everyone should be paying attention to that are and is going to spell nominal nationwide price decline in 2024. Okay, so I'm looking at, besides the stuff I just showed you, 3 leading factors. All right, here they are right here. Factor number 1. All right, and this is why, again, I think this is going to lead 2022. I keep referencing 2022 because we had deflation and price decline in 2022. People just forget because we ended the year up, because remember, the first part of 2022, it blew up. But people so they forget that it went down the second half. But here's active listings. So inventory is high. It's actually the highest it's been in 4 years. It's a 4-year high for this time of year. We're at about 955. We are so close to 1 million, and we're sustaining. This is great stuff. We're well ahead of 2022, which is in black. So we have inventory skyrocketing. Leading indicator number 2, price declines. It's we can't even fathom the price. I mean, it's historical. The amount of people that are slashing their prices right now because they have to sell, need to sell, or want to sell is unprecedented, guys. Look at this. And again, look at the black line. Okay, we're over or matched. We matched the peak of 2022 right now. So we may hit a new record next week. We may hit a new record next week, you guys. So again, inventory. Number 2, price cuts. The 3rd leading indicator. I mean, let me get a drum roll, man. I mean, I'm telling you guys, days on market. 4-year high. We got 4-year highs across the board in all 3 of those leading indicators. Days on market is 31 days. This is median days on market, 31 days. You guys, I'm telling you, whether or not here's the thing. I'm going to be more cautious. Okay, I'm going to be more cautious. But I also want you to know, and you may see how polarizing the comment section is starting to get. The reason why the comment section is getting polarizing is because, well, it could be a few things, but the haters, you guys, honestly, they really don't know what's going on. Like deep down, they're like wondering, wow, I wonder if he's right. They're hating because we're hurting their money flow, or they're just hateful people in general and have, nowhere else to go. But I'm not for 1 minute thinking people are watching my videos and hating just to hate in life. I don't believe most people do that. The comments that you guys are saying are people starting to fall apart and crack. And look at, again, go to the comment section in these videos and see how polarizing it is. Now, here's the thing, and I want to tell you this, okay? I'm not going to delete comments. All right. And I see some people, oh, Travis, you just deleted my comment. No, I didn't. The censorship right now, you guys, is insane. I'm not supposed to say anything. I promised Melody and Jack, okay, we're going to say this together, but we're getting censored as well. So there is censorship. And here's my deal to you. I mean, as long as it's not like any crazy psycho, like racist type of vulgar type stuff, you guys, you know what? If you want to complain, you want to whine in the comment section, it's your God-given right to do so. I'm not going to censor you. Because I'm worried. I believe it's possible that one day trolling is going to be illegal. Think about how scary that is. We're not going to have Johnny. Johnny will go to jail. You see, guys. So I don't want to be a part of that. I want people to talk and ask questions and complain and whine and cry if that's what you want to do. I am not going to delete your comments because I'm an American, you're an American, and I don't believe in silencing you. All right? Even if you're a nonsense, ridiculous troll, okay? Because generally, honestly, guys, usually when trolls are trolling, they're usually talking about themselves anyways. But the censorship is real bad. It is. It's real bad. Anyways, guys, so that's just my little rant for one of the many rants for this morning. We're going to go into our next video right now, which is going to be on pending home sales. It's a very short video, so let me play this real quick. And if you guys can, let me know that the audio is okay. I hate this scene, but you guys like the bear? Did you guys you know how hard it took? You want to hang a bear this high off the ground, like 4 feet out? You want to know how hard that is? I don't think you guys want to know. But I want to tell you, though. I just want to feel proud of myself. All right, guys, here's our second video.
Of housing with Diana Olick. Hey, Diana.
Hey,
Carl, good morning. Yeah, pending home sales in May dropped 2.1% month to month, and we're down 6.6% from May of last year. That's a miss. The street was looking for a slight gain, probably because mortgage rates dropped back a little bit in May. This pending count is based on contracts signed during the month. Rates had spiked in April, and so we saw a sharp drop in pending sales in April, but rates fell back a bit in May, likely why the street thought there might be a gain, but home prices are still very high and still gaining. Inventory, though, continues to improve, but much of that is that some homes are just sitting longer on the market. Active listings are up roughly 35% from a year ago, but that is coming off a near record low. So keep that in mind. There is very little supply on the lower end. Most of it is on the higher end of the market. Regionally, sales were split month to month, higher in the Northeast and in the West, lower in the Midwest and the South. Sales in all regions, though, were lower than they were in May of last year. Now, the realtors are forecasting a busier second half to this disappointing first half of the year. They predicted mortgage rates dropping and price gains at least stabilizing. But, Sarah, I'm not so sure I agree.
Oh, you think what? Prices are...
I think prices are going to continue to gain. I don't know that they're going to gain much more, but I don't see them coming down very much because given the supply and demand situation, there's simply a floor under them. And as for mortgage rates, they have been very stubborn in this kind of 6.5% to 7.5% range for a while now. They could drop a little bit, but I don't think enough to really make a difference for.
Yeah, the prices have been stubborn. The interest rates have been normal. So I mean, just these people, I just can't stand hearing some of them. Anyways, Winnie the Pooh has John said this looks like a haunted mansion behind me. That's messed up. Makes me sad. I also don't like this lighting. And you guys, I know I look a little roughed up. I've been moving. I'm sorry. I just wanted to get here today on Friday. I'm proud of myself, but I want to work hard with you guys. So Winnie the Pooh brought up a really interesting income calculation. So when it comes to qualifying income, you guys always hear me talk about qualifying income because there's the money that you make in reality. And there's the money that you can use for a loan, right? That's called qualifying income. And there's certain things, parameters that you have to meet. Now, what's interesting is Winnie the Pooh's actually right on fixed income, SSDI, which is Social Security income. So fixed income, this is crazy, guys, because it's tax-free money. You get what's called gross it up. So he's saying that in reality, he was getting $1,227 a month, but because they're not taxed, they gross that up by whatever their tax bracket is by probably 15% or 20%. And they actually use $1,500 for gross income. Now, let me ask you guys something. Is that helping or hurting people? If you're on a fixed income, that means your income is fixed. And what happens when property taxes go up, homeowners insurance goes up? If anything, if people on fixed income, and I'm not knocking you, Winnie the Pooh, there's issues. I'm just saying I don't like people getting hurt. And that's it. And the lending standards are absolute garbage. And I hear all the time, oh, it's nothing like subprime. You're right. It's nothing like subprime in that we have to verify income. But as far as the unaffordability and recklessness of purchasing, it's the same thing. Because remember, FHA, they're using 56% of gross income to qualify. Not net, gross. Net is 65%. So if a life event happens, people are in danger. So if you're going to buy right now, do it wisely, or just don't buy. Just don't buy. Just wait a little bit. Wait till after recession. Wait till after election. We're going to move on to our recession and liquidity talk. We're going to have a little talk now. Let me cue this up. All right, so let's start with the recession indicators, okay? So we're going to start with our main indicator right here. Now, if you guys should know by now, but this is the 10-year and the 2-year inversion. This is a single set of data that's one of the most trusted sets of data that is there to call a recession, all right? So again, this is just one set of data. That's why everyone uses this so much because it's just one thing and it's very, very trustworthy. And you guys, we've been inverted for the longest in history. We started inversion April 1st of 2022. We have been inverted the longest in history. This is a massive warning sign of a recession. And despite what you're hearing in the headlines, everyone's from the bond market you see right here, they're betting a recession is going to happen. Not going to happen, is going to happen. You see that in the inversion, y'all. This is a huge indicator, but here we have another massive indicator of a recession. Okay, go back and check this yourself. The unemployment rate. People are like, what do you mean the unemployment rate? It's only 4%, you crazy doomer. It's only 4%. It's historically low. I'm not talking about the 4%. That's not the indicator, okay? The trajectory is the indicator. Unemployment doesn't go up, guys. Unemployment only goes up when we're about to go into recession. Go back to the 1960s, okay? Look at the unemployment. When it goes up, recession is right around the corner. Look at, literally, go to Fred unemployment and put in Google Fred unemployment rate and go back and look. Seriously, look, unemployment rate goes up, boom, recession. Y'all, this is the second indicator. So we got two indicators. Number one, the most trusted one. Number two, this may be the most accurate indicator. Okay, this may be more accurate than the actual yield curve inversion, the trajectory of the unemployment. Those are two massive distinctions, two massive things. But look at this. This is also a huge indicator that we have a recession coming, because the only reason we're not in recession is because of this. This is the deficits. This is not the total deficit. This is just what the deficit is for the year to date so far. We're at 1.2 trillion, and we're not even in technical recession. Now, I get hate in my comments. They're like, Travis, we've been in depression since 2022. I'm not arguing. I'm saying technical. Technical. They're lying to us. They're manipulating the data. They're doing money printing, you guys. I'm just saying, like, technical, so that my neighbor gets to wake up. We're already awake, but my neighbor needs to wake up. We need technical recession called, so that all these people behind this door wake up that are not watching this channel or other channels. $1.2 trillion year to date. And just for some reference here, and I know we would have to adjust for inflation, but during 2009 great financial crisis, we were at a $1.4 trillion deficit. Again, if the economy is healthy, we don't need this type of deficit spending, guys. The economy is not healthy. Those are three indicators I showed you. Three indicators I showed you of what's coming. And it's going to be painful. Now, let me show you this, guys, okay? Let's go to the liquidity part. We just talked about the recession indicators. Let's talk about why we're not in recession. The freaking money, the liquidity, the inflation, the bank term funding program, they're still printing and they're killing us. Now, look at this crazy crap right here. This is a reverse repo market, by the way. This is like the suspension system in the market. This is like the excess money, not our money. Our money's gone. This is the excess money in the market. Look at, guys. Look at that trajectory. It started going up again. That's incredible. That is incredible. The reverse repo market is going up again, not down. So again, case in point, there's the reason why we're not in recession yet is there's so much liquidity and money in the market that who's paying for? Raise your hand. Everyone raise their hand right now because you're paying for that. Okay, raise your hand. You're paying for it. You guys are paying for it just like me. I don't like it. But the liquidity is getting worse, which means more money, inflation. The inflation is getting worse. Look at M2. M2 updated. M2 has reversed. I'm going to call this a trend now, guys. So I would say when it started happening, October 30th, that was the low. And then look at, here's our next low. Here's our next low. M2, this is the money supply. This is also a gauge of inflation, has been going up. So it went down for the first time in like 100 years, but it has again shifted as of October of 2023. This is why I don't think we're going to be called a recession, a technical recession, October 2023. We may, Danielle and Melody think it will be called October 2023. There are a few people that think they're going to call the recession October of 2023, where I'm showing you right here. But I don't think so. I think because that deficit, it's just that deficit spending gets back into the economy. That economy starts kicking that money out, starts developing more debt, more spending. I don't know. We should be in recession and depression already, by the way, but the government keeps manipulating things. I'm just letting you guys know inflation's still here, guys. And it's possible it's going to get worse. And we also see it in the Treasury General account. Let me move this. This is the Treasury General account right here. It's also gone up. So they got a lot more money. Okay, they got a lot more money. They got $723 billion to spend. This is the Treasury. They already have this money to spend and kick into the system. So we have all of this liquidity. But again, you guys, the thing is we can't afford it. Americans cannot afford it. And I don't know why we cannot get these bulls to acknowledge this. This is real income. This is what I'm saying. Real incomes went down since 2019. Look, it's gone down. So since 2019, real median income has gone down. Cost of living has exploded. We have all this inflation here still that we're paying for. I mean, the consumers can't afford this. It's straight up. It's a fact. And not only can they not afford it, consumers can't save. Consumers can't save, guys. Even if most people wanted to save, they can't save. Now, I'm going to disagree with that. I still think people could save if they were more disciplined, but the savings rate's in the gutter. So again, people are making less money adjusted for inflation. People can no longer save. Savings rate's 3.6, and they stop paying their bills. Now people are like, no, it's still low. It's still low. But just like unemployment's low, I'm not talking about the low number, guys. It's the trajectory. It's the trajectory that we have to watch. Now, looking at this chart, when's the last time the trajectory for delinquency rate went up? Okay, you're looking at delinquency rate on a quarter over quarter basis, and you guys obviously see the trajectory is skyrocketing up. It's actually more than it was since, what do we have, a 2011 high, 2012 high. But when's the last time that's went up, guys? A little bit right here, I guess. Yeah, you could say it went up a little bit here. But look it went up here, boom, into recession. It went up here and then led into recession. So the trajectory is going up. So again, I showed you all the leading indicators, why I think we'll have nominal. I told you the health of the consumer. We talked about how much of the economy is based on consumer spending habits, how important trust and confidence is. I mean, you guys, consumers are starting to wake up. I mean, do you guys disagree with me? But I care about you guys waking up. I want you guys to wake up. And by the way, if you guys have any good stories, email me. I'm getting some emails, some crazy stories. Any crazy story, anything bad that's happened to you, email me. If you guys have a great story, email me or join the Discord. Either way, let's go into our next video, which is going to be JP Morgan. JP Morgan basically saying there's going to be a selective type of recession, but at least they're saying recession, right? All right, so I hope you guys enjoy this. I really appreciate you. Again, guys, happy Friday. Isn't it great? You guys made it. Congratulations. We all made it, by the way. I almost didn't make it.
Breathless coverage today because it is pretty astonishing. What do you make of these massive stock moves, first of all?
Yeah, look, Art, the backdrop that we see from a macro perspective based on our work is a selective recession. And what that means is you are going to have extreme volatility. We think the higher income consumer, a lot of wealth creation, nearly 40 trillion by our JP Morgan economists. So that higher income consumer, they're being more choiceful. They are demanding best in class brands in the channel where they can get it conveniently. The low income consumer, that's the melting ice cube. And that's where I think you're seeing on the discount side some of the consolidation and a number from a competitive perspective of weakness that you are seeing out there.
So you said selective recession. Does that mean you think one is coming, or do you think we're already in one from a retail point of view?
I think we're in it. And so I think the higher income consumer, completely fine. Again, 40 trillion of wealth creation. That consumer makes up roughly half of consumer spending. The lowest cohort of consumers out there, the lowest 20%, only makes up roughly 10% of overall consumer spending. Wow. That's the consumer that you see the headlines around. And that's that consumer that is gravitating to those value propositions. And I think that value convenience, that's where it's a lot more competitive today, especially with a lot of the big box and e-commerce out of the pandemic.
When I look at the grab bag of declines today, the fact that it's Walgreens and H&M, I think to myself, is that a consumer story? Is that a low-income consumer story? Is that just an e-commerce story, and how Amazon is not only supplanting the pharmacy trip, but supplanting the quick fast fashion trip that you might have used to go on, or Temu or Shein?
I think it's a combination of all. And so I think if you really take a step back, one of the things that changed coming out of the pandemic is the consumer backdrop became more convenient. You have buy online, pick up in store from Walmart, Target, all of the grocery stores. And you have breadth of offering with e-commerce as you think about Amazon and the pure play e-commerce digital plays. So when you put that all together, it's a lot more competition at brick and mortar for the historical value players, which would be the Walgreens of the world, the Dollar Generals of the world, a lot more cutthroat competition. And being equal on price to the discounters might not be enough, because now you might not be as convenient given that technology advance that's happened outside of their world.
Retail is always a big favorite of hedge funds and investors who think they might be able to make more or less quick money that way. If they can find the right kind of beaten down player, jump in on an inflection point. Look at Abercrombie and the massive increases we've seen over there. So if we're in a selective retail recession, where are the stocks where you think that's already priced in? Which ones could be vulnerable to further declines? And which ones might actually be able to kind of get the right sizing behind them and then become a more interesting opportunity?
Sure. The way we size it up, that consumer price, as you said and kicked off, the days of just pushing price are over. you need product improvement. So off-price retail, TJX, Burlington, Ross stores, they have brands for great value. They're not pushing price. It's that value component where the consumer comes in, that treasure hunt, and they're wowed. So I think off-price sets up very well. Consistent unit growth stories. Ollie's more in the mid cap, I think also fits really well in the non-apparel side of that. Dollar Tree, I think, is very interesting in terms of that discount world, a storyline that could have a greater growth profile going forward than looking back. And then you have to be number one on the brand side. So a Birkenstock, very strong growth story multi-year. I think on the value side, some of the changes that a PVH is putting into place with the Tommy and Calvin brands makes a lot of sense from a profitability perspective. And last, I would say on that cruise and leisure side, look, that is a space very similar. Winners versus losers. You have to have the value proposition. And the cruise space, I think, sets up really well. Royal Caribbean, top of the list.
Yeah.
And then I would say Viking and Carnival also set up very well.
Y'all, just because these guys know how to talk doesn't mean they're right. They may out-talk people, but again, that does not mean that they're correct. I mean, it's just like listening to an encyclopedia salesman, to be honest with you, at least in my opinion. Let me see here. Let me minimize this so I could see real quick. I wanted to show you guys a couple things, and I'm going to do a couple comments. We're about done, though, but I just, and I got a couple requests as well, but I wanted to remind us of like to stay in the solution. We talk about the issues, we talk about the challenges, we talk about the warnings, but don't let that cripple you. Stay in the solution. And again, I want to eventually, hopefully one day, again, soon, hopefully in a few weeks, even, I'm going to start a school. I'll have more courses. We'll be a stronger community. It's going to cost money, obviously. I have time and effort. But again, for the meantime, remember, guys, I made you a free home buying course. I have 20 years of experience, over 20 years of experience. And I just want to remind you guys a couple of the things that are still in there. So if, again, don't get paralyzed. Like, what do I do? Like, just quickly take this course. It's right here. It's in the link in the description. It has a section on credit, income, assets, different types of mortgages, why a payment is important, why a price is important, investor mindset, wedge basics, cash flow basics, what to ask a seller for. I mean, I did this for y'all. I don't get any money at all. In fact, I get grief because it costs me money and my email gets overwhelmed with so many emails of people joining it that I just can't keep up with my emails. But again, guys, it's there. So if you want to learn, it's there. I put my effort in. Please take it. If you haven't taken it, Charlton, you better take that. And again, no matter your level of expertise, you should learn something in my course. You should learn a lot in my course because that course I made that course that's based off of a loan officer and a realtor, for decades, right? And someone that lost everything. So that's my perspective there. And I care about first-time home buyers, specifically first-time home buyers. All right, so we got a comment here from Locked Up Larry, getting 2% on savings plus a nice size down payment and near 5% on certificates. I brought this comment up because I was wondering why you're not getting 5% like the half of America, brother. You're missing out on 3%. It sounds like I'm not a financial advisor. Edward, it would be nice. Okay, I would not be waiting for the mortgage rates to go down, but the price of the house is my cinnamon towards buying a home. So I have a chapter on exactly this. Okay. Almost every, I can't say like everything, right? We can't say things with certainty, but almost every scenario, in my opinion, the price is more important. Like, I don't know why that's so hard to understand. The price is more important. The price is more important. All right, you guys, I think that's going to do it. All right. Well, happy Friday. You guys, again, do me a favor. Take that course, rebudget. Don't go out drinking. And do me a favor. All right. Do me a favor. Go to the price is more important. Exactly, Jeremy. Do me a favor, guys. All right. Love yourself. Be proud of yourself. Be disciplined. Gain confidence. And, love yourself and love the relationships. Go buy coffee for someone. See how good it feels to love someone that doesn't deserve it. All right. That's the type of community I want around here. I want people building people. I want iron sharpening iron. I love you guys. Thank you for the 100,000 subscribers. I still haven't made the post because I'm a loss for words. Can't believe we've made it this far. But happy Friday. I love you. I made the Friday morning live. You guys will have no idea how painful it is to set up this horrible studio, but I did it for you. I love you. Happy Friday. And if you're out there investing in real estate, you guys already know I wish you luck. And I hope you win.